if you have to go buy something and you have both Bitcoin and dollars, which one do you spend first?
I want to spend the dollars first. I mean,
And why is that?
yeah, I mean, it's Gresham's law, right?
Right.
Bad money drives out the good. It's like, you understand intuitively that, one money is going to be losing its purchasing power over time, and one is going to be more valuable over time. It's going to protect your purchasing power.
To create a sustainable system, you have to generate revenue that you can pay to the miners, right? So I need to generate a large number of transactions to maximize that fee that's paid to the miners for security. To get a lot of transactions, we want a money that has high velocity. So in the system, you actually want a money that's technically preferred to spend. So in the context of Bitcoin, even if Bitcoin could do, say, 50,000 transactions per second, even if you say Lightning is perfect and is a scalable situation, there's still the problem that nobody wants to use their Bitcoin. Would you ever sign a contract with your employee that pays them denominated in Bitcoin?
I mean, I do. Because
do you really?
I'm in this shit. I pay.
No. I say contractually. So you would sign a contract with somebody saying that their salary is 2 Bitcoin a year?
No, reference the dollar.
Yeah. See how that works?
Yeah.
So that's the problem. So unless you create an alternative unit that's endogenous to the crypto system, you're actually making the crypto systems remain dependent on the fiat systems.
Welcome back to another episode of Cypherpunk'd, where we explore money's history, crypto's future, and Web3's role in advancing human rights, freedom, and digital liberty. Today's guest is Dr. K, the CTO of Quai Network. This is part 3 of our series on Quai Network. Welcome to the show.
Appreciate you having me.
Today, I'd like us to talk about the tokenomics of the project and the dual token economy that you've created here, which is kind of novel and interesting. Let's start with the basics for our audience here. Could you explain what Quai and Chi are, and why you decided to create 2 distinct tokens instead of just one?
Great question. So Quai is an EVM-compatible token, which means it's programmable like Ethereum, and it has a deflationary emissions model. So, that means the inflation rate is going down over time in expectation. And with that, there's certain expectations, I guess, with price, much like a Bitcoin or an Ethereum. The second token is Chi, which is based off of a UTXO model. And we call it an energy dollar, and it is designed to track the sort of production cost of miners, which is largely dominated by electricity prices. And the point of Chi is to create a unit of account that's endogenous to the system, as well as a medium of exchange. So the way that it creates a unit of account is because miners' sort of electricity prices are relatively consistent over time. If you create a unit that sort of references those, you can create a flat coin, which is a stable coin alternative.
Mm-hmm. So it's not a reserve-backed stable coin, but it references the price of energy.
Correct. So that we can get into the mechanics, but there's market mechanisms that cause that reference to take place. And the point of it is to have something that you can price goods and services in that has reasonable stability over time in terms of purchasing power, so that you don't have to create dependencies and references back to fiat money. So if you want to have a truly independent financial system, you can't say we're still going to denominate everything in dollars. There's then become custodian. You have the custodian dependencies, et cetera, et cetera. You actually need to have, a unit of account in the system. And then she's also functioning as a medium of exchange in that it has cash-like privacy properties. And that's one of the reasons that it's on a UTXO ledger versus an account ledger. So why 2 tokens? So there's 2 parts of it. One way to think about it is to create a truly decentralized global monetary system. A monetary system actually has to have 3 properties. You need a store value, a unit of account, and a medium of exchange. So Quai is designed to operate kind of as that store value, whereas Chi fulfills the unit of account and medium of exchange. And then another way to think about it would actually be something like Gresham's law. So if we look at something that's sound money, and in history this would be gold versus paper notes.
Mm-hmm.
Maybe in more modern times you could think of Bitcoin versus dollars.
Yeah.
But when you look at Bitcoin versus dollars, if you have to go buy something and you have both Bitcoin and dollars, which one do you spend first?
I want to spend the dollars first. I mean,
And why is that?
Yeah, I mean, it's Gresham's law, right?
Right.
Bad money drives out the good. It's like, you understand intuitively that, one money is going to be losing its purchasing power over time, and one is going to be more valuable over time. It's going to protect your purchasing power.
Right. So you're always going to spend your dollars first, unless there's some very like odd situation where you can't sort of use dollars. So maybe if it's an international payment, to somebody in Russia, for contracting services, you're gonna be like, I really want to pay everybody in dollars, but maybe Bitcoin's a better mechanism here because like I don't have a direct line in the dollar rails, right? So only in those very rare situations are you gonna like tap the Bitcoin if you have the dollars to spend.
Not even anymore though, because you can use stables now. So stable coins. But yeah, I see what you're doing.
So dollar or dollar rate proxy, like whatever it may be. But you're still gonna spend the dollars first. So if you have the dollar denominated stables, you're still gonna spend those before you spend the Bitcoin.
Yeah.
So, one thing that we see is that to create a sustainable system, you have to generate revenue that you can pay to the miners. And ideally that revenue is coming from transaction fees. And if I want to maximize sort of the security in the system and the revenue that's paid to miners, I need to maximize the revenue, right? So I need to generate a large number of transactions to maximize that like fee that's paid to the miners for security. So if we then look at the properties of money, to get a lot of transactions, we want a money that has high velocity. So in the system, you actually want a money that's technically preferred to spend. So in the context of Bitcoin, even if Bitcoin could do, say, 50,000 transactions per second, even if you say Lightning is perfect and like is a scalable situation, there's still the problem that nobody wants to use their Bitcoin, right? So in that situation, like Bitcoin suffers from this Gresham's law phenomenon, like you said,
that's how
where
I
the
feel
good
about
money
Bitcoin.
is hoarded
I want to spend my Bitcoin,
and the bad money is circulates, but that is a disadvantage to the system because it potentially impugns the security and the revenue generated to the chain because it doesn't have a quote unquote inferior or currency or a currency that encourages velocity within the system. So the other piece of this and the way to think about it is you want two things in the system. You want to store value that encourages hoarding, but you also want something that has slightly inferior future expected value characteristics, but has the advantages of having privacy and cash-like properties as well as functioning as a unit of account. So you can actually denominate goods, services, and contracts in it, and it encourages velocity. And if you do that, you can create a system that generates revenue because it generates transactions. So you look at the Bitcoin mempool right now, Bitcoin transactions are very, very cheap because people are getting more and more exposure through custodians, and everyone's hoarding their Bitcoin and spending everything else. So like you don't actually see the throughput, and without the throughput or without the transactions, you're not getting the revenue, and the revenue is important, long term for security. So within Quai, we basically said, we know that there's enterprising individuals in society that will create bad money. They will create money that encourages higher velocity. So to have a system that like will do high transactions, you can't just have a hoarded entity. You also have to create an entity that creates velocity. And then now the next question is then why would anybody hold the secondary token? And the reason they would hold the secondary token is because they want to price goods and services in it because it has a more stable value and it also has cash-like privacy properties. And if we look at what has happened in the market, in the crypto market, 70% of transactions by value right now are happening in stables, right? That's like great in some ways, but that's terrible in others. It means that people want the transferability and ownership properties around crypto assets, but none of the native crypto assets give the stability to be used as money. So we're falling.
It's kind of like a chicken and egg problem. I mean, there's one characteristic of money which is known as acceptability, which it's hard to time is what gives you that, increases that characteristic, and we're not even 2 decades fully into this whole idea and concept of Bitcoin and blockchains and Web3. So it's still very, very early.
Well,
but yeah, I hear what you're saying.
But I mean, the reason for it isn't just the concept of acceptability, because like you and me would both accept Bitcoin,
of course.
But would you ever sign a contract with your employee that pays them denominated in Bitcoin?
I mean, I do.
Do you
because
really?
I'm in this shit. Like, yeah, I mean, I pay in
No, no, no,
crypto,
no, no. I say
Bitcoin, and everything like that.
contractually. So like you would sign a
Oh,
contract with somebody saying that their salary is 2 Bitcoin a year.
no reference to the dollar rate at the
Yeah.
time.
Yeah.
Yeah, I see what
See
you're
how that
saying.
works?
Yeah, 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 yeah.
So like that's the problem.
Yeah.
And so unless you create an alternative unit that's endogenous to the crypto system, you're actually making the crypto systems remain dependent on the fiat systems. And so because we can't sign those contracts, we can't delink.
I see what you're saying right now. I mean, I think this changes as time goes on and acceptability increases and volatility goes away. But yeah, I mean, I think we're incredibly early, uh, in where we're at in the process right now. I think we're still, that S curve of adoption is so low that there's still so much volatility ahead, especially with something like Bitcoin. That yeah, what you're saying is 100% accurate.
Yeah. So that's really the purpose is if you want to have a system that has risk on aspects, has risk off aspects, has something that encourages hoarding, has something that encourages spending, while fulfilling sort of the three properties required for monetary system. The minimum number of tokens you need to do that, as far as I could design them, is 2.
Interesting. I think that's kind of like the holy grail. There's been so many of these like stable coin, what do they call it? Non-pegged, like Terra and like Luna. And like there's been these experiments over time to kind of have this non-reserve backed algorithmic stable coins. You talk about Qi as a flat coin, not really necessarily a stable coin. I'm still trying to like grasp. Can you give like a actual example here? Like, what are we seeing with Qi's price right now? Like, what is it kind of stable, or what are we seeing? I mean, it's super early. Qi just rolled out very recently. I haven't even like dove into it, and like my team is trying to figure out, should we mine Quai? Should we mine Qi? Like, all these different factors come in. We'll talk about that in a minute about how miners should optimize around this, but maybe you can explain a little further.
Yeah. So when we talk about stability and we talk about like what we're trying to achieve, like let's first run the criteria, right? So when we look at currencies and what people are willing to sort of, settle and sign contracts in, you need something that maybe is like plus or minus 10 to 20% per year in purchasing power to create like a stable asset.
Yeah, yeah.
So if we look at like the referential price that we're trying to peg here, which is electricity, if we were to compare the volatility of the US dollar to Canadian dollar peg, it's about 4 times more volatile over the last 40 years compared to the electricity prices. So the point that we're trying to reference is a good fundamental reference. And then the second thing that
it's based in physics. I mean, real energy cost,
exactly. And in some ways, like the miner energy costs are even dampened more than like the market energy costs, because miners sign longer term contracts, which actually dampens price volatility even more. But the point here is the reference is a good reference, and then you just have to create a market and a mechanism which is then tries to dynamically go to that reference point. So the volatility that you realize is both a combination of the underlying reference point, which we said is very good, and then there's the control that's achieved, but that is ultimately a outcome of the market participants. So as the market participants grow in number and the liquidity of sort of the Quai Qi pair increases and market participants become more educated and sophisticated, the volatility of the control will tend towards 0. So then you'll ultimately, ideally, in a perfectly efficient market, see Qi only reflect the volatility and energy, because the aggregate outcome incentivized by the total market participation drives the arbitrage opportunity to 0. Now, obviously, it's very early on, and a lot of those assumptive statements that were made around Qi aren't quite yet realized. We don't have like a fully liquid external market. We don't have a ton of efficient, educated market participants. So there's more variability in Qi.
Yeah,
so like right now, like maybe, as hash rate like wildly fluctuates because there's like an issue with a pool, Qi might go plus or minus 20% in a week where it's supposed to do that in a year.
Yeah.
But at the end of the day, like it's still converging back to its sort of equilibrium value. And as the, markets become more liquid and the participants become more sophisticated, you would expect that pricing to be very stable. Is kind of the answer. So
Interesting. How do the emissions and supply curves for Quai and Qi work?
I think we should dig into Qi a little.
Okay, yeah, we can for sure.
A little bit more. Well, and maybe we can talk about emissions of Quai and Qi as to circle into that.
Mhm.
Right. So I'll make two statements. So one statement is that the emissions of Quai are proportional to the log of diff. Okay. So the binary log of diff. And what that means is that as the hash rate goes up in the network, the emissions of Quai tends to also go up per block. But over time, you're still causing the total emissions from a percentage basis to go towards zero, if that makes sense. So like the inflation rate tends towards zero, though the emissions per block will tend to go up if miners are willing to mine at a higher hash rate. That's like the statement with Quai. The statement with Qi is that it is emitted proportional to hash. And so the idea is that Qi is like a tokenization of hash.
Mhm.
And that actually makes Qi an asset, not a debt, because it is changeable in the system for Quai depending on what the system is determining is the market discovered exchange rate between Quai and Qi, knowing that Qi is a tokenized hash.
God, this is so confusing. Just when you say all of it, I mean, it's just like it just goes over everybody's head. It's like, because again, like my next question was going to be like, as a miner, how do we create efficient markets here? Because like my team is pretty sophisticated, and I know, like, trying to understand the economics of this. Like they're struggling with it, I'm struggling with it. Is there like, how can you simplify this to like just super simple if you're talking to like a miner who doesn't know anything about economics, doesn't know anything about all these other mathematical functions and processes? Like how would you explain it to a 5-year-old? Eli 5 this, I guess, is the question.
Yeah, so it's pretty simple at the first order of complexity.
Okay.
Which is if there's an external market that has a rate between Quai and Qi.
Explain what an external market is.
So that could be a DEX, that could be a SEX, but some market that allows you to exchange Quai for Qi.
So it could be a peer-to-peer marketplace, it could be a decentralized exchange, it could be Binance, it could be Coinbase, right? Something like that.
Yeah. Or it could be any of those, all combination of those.
Yeah.
Just a market.
Gotcha.
That allows the market to efficiently discover what it thinks the pricing should be between the two.
Mm-hmm.
There is also a protocol offered exchange process that has a protocol offered rate. And as a miner who is mining, or as a speculator who is trying to make money through the process of arbitrage, you should just look at the spread between the offered rates and then make your choices to close the spread, which is to make money. So if you look at an example would be, if from back in the day, there were spreads in Japan on Bitcoin, right? So if you try to get Bitcoin in JPY, there's like a 20% price premium relative to Bitcoin and USD.
This is a South Korea thing. We call it the South Korean premium or something like that. That was a famous.
Well, the South Korean one was there too, but there was a JPY one as well. It was like Southeast Asia had these spreads, and so what people did is they would buy, Bitcoin in dollars, send them to the Japan exchanges, sell them in yen, and then convert the yen back to dollars.
Yeah.
And when they did that, they made the spread, but they also caused the spread to close. That's
arbitrage.
This is arbitrage. This is arbitrage.
Yeah.
So in the case of, Quai and Qi, as a miner or as a speculator, if you have an external rate that says, it takes 10 Quai to buy 1 Qi, and then you have the protocol rate saying that it only takes 9 Quai to buy 1 Qi, right? I can then, in this case, if I want to increase my thing, I would buy Qi from the protocol, and I would sell Qi at market, and I would make the spread, right? And so then what would happen is the protocol and the markets then have to come together, So then when they get to equilibrium, maybe like the equilibrium number is 9.5 Quai per chi. But the fact that like you're buying here and selling there is causing that spread to close, just like you cause like the JPY Bitcoin spread to close. So if you like understand how to classically do arbitrage as a miner or a speculator, you'll have two markets and you just classically arbitrage the markets. And that mechanism is the mechanism by which the protocol understands what the external market's doing. So it creates like this decentralized oracle, which is everybody can make money here. And the way that you make money is by closing the spread. But then that tells the protocol what the external markets are doing.
Yeah, it's interesting.
Right? So then it creates an internal referential price of the external markets by the arbitrage opportunity.
How does the protocol do this on you? I mean, how does the protocol let you do the swap? That's what I'm trying to understand is like, how does that work? How does that build into the tokenomics? And
so in the tokenomics, there's two mechanisms that you need to get chi to work. So the first mechanism is chi is emitted proportional to hash. Okay. So what that means is as a miner, you would choose to mine chi if the market price is above your cost of production. Okay. And you're going to do that until the market price starts to converge to the production cost. Okay. So that's one mechanism. Now, if the market price is below the cost of production, that means there's too much chi supply and we need a mechanism to take chi out of the market, right? So that's where the second mechanism comes in, which is a protocol offered exchange rate. And so at any point in the system, you're allowed to burn chi and mint Quai or burn Quai and mint chi at this protocol offered rate. Okay?
Fascinating.
So this allows for perfect elasticity in the quantity of supply of chi because it allows people to expand and contract the supply of chi, but it's only incentivized to happen in a profitable way until the price of chi converges to the production price or the production cost. So that's how it's sticky to the production cost. So like in this system, I didn't say like, I guarantee you this many Quai for this many chi. I said there is a market mechanism, which the market participants ultimately determine what the exchange rate should be, and then that mechanism is offered to people, which allows the supply of chi to expand and contract in the required amount to then get chi to reflect the production cost, which then makes it stable in market equilibrium, assuming market efficient participants. So there's no like peg. There's no guarantees, right? What is a chi worth? It's what you're able to sell it for. But the idea here is those two mechanisms make what you're able to sell it for ideally be the same over time, if that makes sense. Right? So it's really trying to preserve purchasing power, but we're not doing it in any pegged way. So like, let's say there's like a panic in the market and like the supply of chi has to contract or expand. There'll be times when like, you know, the market clearing price of chi is below the production cost. There will be times when the market price of chi is above the production cost. And in those points of time, there is incentive for people to come in and arb the market and close that gap. And if you're one of sort of like the panicked sellers, you're going to suffer a permanent loss. But as the markets become more efficient and more intelligent, the ability for those things to move away from the equilibrium price becomes less. So the market becomes more liquid, the market becomes more efficient, and it is more often in equilibrium than in disequilibrium. So again, there's no guarantees. And let's say there's like a huge shock to chi. What's going to happen if the, suddenly, a country decides to adopt chi as like a national currency or something? That's like a huge shock to demand in a positive way. What's going to end up happening is the price of chi is going to be above the production cost. So miners are going to be like, I'm going to mine the shit out of chi. And speculators are going to be like, I'm going to burn all this Quai and like make all this chi. Right? So then what's going to happen is that price premium to production will then start to close. Right? And anyone that's like violently trying to buy chi is going to suffer in permanent loss, like as this closure is taking place. Okay. And then what's going to happen to Quai is the supply is going to decrease while the demand is going up because people are trying to burn it to make chi. So you're going to get, in this scenario, every time someone's creating a chi, it looks like a market buy of Quai in the quantity of one sheet of value. So if, in this shock, let's say there's like a new demand for like 1 billion Qi, that looks like 1 billion Qi worth of buying of Quai, roughly speaking, like in the market cycle. Now, on the counter, let's say there's a negative shock to demand in Qi. It looks like selling of Quai, right? Because you're basically going to burn Qi to mint Quai, so the supply of Quai is going to increase. So that's a little bit more subtle. So that actually isn't perfectly analogous to selling. But anywho, there's a coupling here between the two, but they're counterbalancing. So this actually provides greater stability for both Quai and Qi in the system. But the other thing, if we go back to the original statements of the emissions of Quai are very inelastic, right? So it's like following this logarithmic emissions curve, while the emissions of Qi are meant to be perfectly elastic. But because of this link between the two, meaning to create Qi, I have to burn Quai or forego making Quai, it encourages to Quai always be many multiples in market cap relative to Qi, right? So if we go to the Terra Luna example here, first off,
no death spiral here. That's what you're saying.
Yeah, there's no death spiral because there's no debt.
Yeah.
There's no guarantee in the system. It's just saying in expectation, in equilibrium, like this should be have rough purchasing power parity with time. Outside of that statement, there's no other statement. So it can disconnect, and the way that it reconnects is through impermanent loss and arbitrage, which is fine because that means no matter what shock you put into the system, like you're always going to come back to an equilibrium state. It just may take some time. So there's no like concept of the death spiral because there is no debt. Yeah. I will also say with Terra Luna, when I looked at it, I literally took about 3 minutes.
Yeah.
And I was like, this is retarded with like a hard R, right? This is like a completely malconceived design, and you're going to come up into a problem where you have quote unquote a negative funding rate. It is destined to take place.
Question: it wasn't a matter of if it was going to happen; it was just a matter of when. I mean, that's really what it comes down to.
Well, and then the other thing about
people said that and saw that.
Yeah, like it didn't take a genius to figure that one out. And then the other aspect of it that was like crazy was that the backing token had a market cap that was significantly less than the debt token.
That was wild.
Right. So I think, and this is a few years back now, but I want to say like Terra went to like 16 billion and Luna at the same time was like 6. So your debt token was like 3x the market cap of your like quote unquote backing token, which was like absolutely insane. But the more insane part is that this system was coupled to something completely exogenous. And like that is the statement that fucks you, is that you can't create a system of stability if it's not referenced back to the thing which you're debted in, right? So like if you for example offered your employees salaries in Bitcoin, but you're chronically long Bitcoin because your business is mining it.
Yeah.
That's technically an okay position to be in because every time you're going into a debt, you're also going into a corresponding long. You're endogenously tied to Bitcoin. So that's like a perfectly cool statement to make. But if you're saying, I'm going to pay them in Bitcoin, but I revenue in dollars and I hold all of my revenue in dollars, you just put yourself into a situation where you're going to have a potential negative funding rate because you're short the asset.
Yeah.
Right. So in Luna, you're always short Luna, long the dollar in this situation. You're fucked. Right. Like you're always in a situation where you're going to get yourself in trouble because you don't have a balanced hedge. In this particular case, from the system's perspective, it's always balanced because it's running against hash. It's not running against dollar. The fundamental unit in this system is hashes.
I love it. It's energy.
Right?
Hash rate is
and both Quai is hash-based and Qi is hash-based.
Yeah.
So both of them have a component which is commonly denominated.
Yeah.
And so you don't have this problem where you're kind of like non-risk adjusted against one thing that's exogenous to the system.
Yeah. I'm going to call it a compute dollar. I like that term.
Well, so I'll push back a tiny little bit on compute. So
it's linked to compute, I mean.
It is.
Hash rate is compute.
But we've actually tried to deconvolve compute. So in the system, and one of the questions you might get to is, well, if it's tied to hash, doesn't that mean it goes down over time because GPUs become more efficient, right? And that would be a true statement. But in the system, we actually have a projected efficiency curve that causes the number of hashes per chi to change with that projected efficiency. And the reason that we're doing that is because we're trying to get the purest measurement of energy, not compute. So we're literally trying to deconvolve compute out of the equation as much as possible to get the greatest amount of stability relative to purchasing power.
That's tough though, because you got to guess at that curve. I mean, it's kind of like imperfect information, right?
No, it absolutely is imperfect information, but like the ability to guess that curve right now is pretty good. So it's an
talking
open
about
loop.
Moore's law here, or like
It's technically not Moore's law. For GPUs, it's a different thing because it's like a FET-based system, but there's an analogous. I don't remember who they named it after, but there's an analogous sort of like projected law that, as a material scientist,
look that up, Paul. Give us some information here. Look up the GPU innovation law. They named it after somebody. I want to say, I feel like I've heard this before, but it is interesting. But it's still, I mean, like the famous with my background in statistics, it's all models are wrong, some are useful.
Right, but remember like what the requirement of the model is. The requirement of the model is not to be perfect. The requirement of the model
is it Wang's law?
Huang's law. Looks like
Wang's law.
The requirement of the model is just to try to get you to create a referential unit that's plus or minus 20% volatility in a given year. Like that's
doesn't have to be perfect. Yeah,
it doesn't need to be perfect. You're just trying to create something that is somewhat similar to major currency pairs in terms of volatility over time. And I believe that we can get there.
Yeah.
And that's really the statement. So it doesn't need to be perfect. It can absolutely have some drift. All we're trying to do, like, is you're just trying to get it close so that you're willing to sign a contract in it.
Interesting.
Yeah.
Interesting. Talk to me about, so you guys have an interesting thing. Like I've been involved in a lot of proof of work projects, but I've never seen a project that's taken 2 weeks to have the token mature to allow you to spend the token as a miner. I think that's interesting. Why did you guys decide to do that? How does that work? Explain the logic behind that.
So when we talk about the conversion between Quai and Tree that's offered by the protocol, there's a component of duration that's required to get that controller to work properly. So if I like allow you to do it instantaneously, I'm sort of removing capacitance and I'm removing like averaging in the system. So to like make that sort of endogenous protocol rate work, you have to have duration. And then so the problem is from a maturity standpoint on a Coinbase, if you're like a miner and you want to sort of circumvent the duration component, you could pay yourself like a fee and then take the other currency. Cause like as a miner, you get to elect, do I want Quai or Chi? And because you get to elect if you want Quai or Chi as the payout, you could just like pay yourself a really high fee in one and then elect to take the other. So because there's like a mechanism as a miner with the Coinbase that would allow you to circumvent the duration in the exchange, the maturity has to be the same duration as the maturity in the protocol offered exchange, else the miners would be able to circumvent the duration on the exchange rate.
Interesting. So when you do the protocol swap, is that there's a 2 week on that as well?
Yes.
Interesting.
And that's where the 2 week maturity comes from because it would create a loophole against the exchange rate.
Okay, fascinating. So if I go in, I got to talk to my guys about this, but if we go in and we, say we swap from Quai to Chi, basically I'm not going to get those swap tokens for 2 weeks.
That's correct.
That's interesting.
And that's why you
that
also
kind of makes it hard to arbitrage though, doesn't it? I mean, isn't that defeat the point of an arbitrage?
Well, so the point is it needs to be arbitrage at duration for like the system to work. You need like this average. So the question is, what is the duration period that makes sense to get the long tail of correlated projected averaging? So in some ways, like, let me make an analogy to weather, right? If I ask you what the weather is tomorrow, within like a 90% certainty, they can do all right at getting like tomorrow's weather. And then the uncertainty in day 2 like gets worse, 3, 4, 5, 6, 7, 8, 9, 10. And so what we're asking with the system is we're asking market participants to go out 2 weeks in expectation and say, based off, hash rate, based off energy prices, based off market demand, kind of what do you think the pricing is in 2 weeks? And we think that is the right number where you still can get signal and not pure noise, but it forces them to make predictions under duration, to make this whole market efficient. So we might be wrong in the 2-week number, to be perfectly honest. So there might be a thing where we have to go from 2 weeks down to 10 days or like to a week even.
Yeah.
Because, sort of predictability gets worse and worse as like, duration goes out. The reason we sort of picked what we think the longer end of the tail is because we know that from a market perspective, if we start at 2 weeks and we figure out that 2 weeks is too long, it's going to be relatively easy to tell everyone like, we should really like adjust this to 10. But if we started at 10 and we told them like, hey guys, we actually have to make this 20, like everyone's going to be pissed off.
Of course, no doubt. Yeah.
Right. So like we started with what we think is like a longer number that we think encompasses like the outcomes of that predictable range. And there might be a time where we say this system will actually function better once we get more data, that we can shorten that number up. So we could go from 10 to or 14
What do you guys
to
think
10 to 7.
The data? Have you?
We don't have enough. We don't have enough data yet.
Not enough data yet.
So like I still think 14 is like the right choice for right now. But maybe in like 6 months when we have like more liquid markets and more trading data, we might come back and say like actually it's 10 or like actually it's 7. And it might even be the case where like it's not 14. Maybe we should go to 10, and then we go to 10 and we're like, actually, we think it's 7. And then like, we'll go to 7, but like, we'll see that data arrive over time. And then we'll try to like tune in that window. But so also the interesting thing is like, as the market participants get more sophisticated, like their prediction ability is going to get better.
Yeah.
So we have to be a little bit careful in like how quickly we tighten that, but you do potentially want to like squeeze it down a little bit.
Yeah. So the reason of the maturity is basically because there's that in protocol mechanism where you can convert Quai to Chi.
Yep.
But
so the miners could manipulate that mechanism.
Yeah.
If we didn't have the maturity.
Gotcha. So now I understand though that, so like, I guess the only concern I have is that, if you have to wait 2 weeks to take advantage of an arbitrage, are you really able to guarantee you're actually capturing that arbitrage, or you're taking a risk in making that arbitrage because price could swing the other way?
Yep.
So that is a risky thing to do.
And hash rate's going to swing the other way too.
Whereas when you're arbitraging, it's, when you're doing an arbitrage, like, what your profit's going to be pretty quickly because you can move it over, it clears, it goes to the exchange, and then boom, you lock in that profit, right? There's still risk there, but it's not as much risk as doing an arbitrage that takes 2 weeks.
Yeah.
Correct.
Yeah, no, but we want like market participants to anticipate changes in supply because Quai can't instantaneously like go to Chi. There's like some flow rate that's allowed in the conversion. So, as a market participant, we want you to be educated, we want you to be sophisticated, and we want you to try to make predictions on the long end of the curve, because the longer you can make the predictions and still have good predictive outcome, the more stable the system becomes. So we're incentivizing behavior that creates better convergence to equilibrium stability. We're asking you to be smart. We're asking you to predict out. And if we
That's a lot to ask. It's a lot to ask, especially for miners. Who are historically just. I'm thinking as a miner. Like, our job is to, provide security to the network and keep the blockchain going. And
the interesting thing here is miners don't necessarily have to participate here.
They don't have to be the arbitrage.
No, they don't.
A totally different section of
like from a
network participants, right?
Yeah, that's right. So like from a miner's perspective, the miners can basically choose: do I want to go long? Do I want to go risk on Quai, or do I want to go risk off on Chi? Which is also interesting because as a miner, you guys are always risk long the asset that you're mining.
Yeah.
And you have to go into TradFi markets to like try to go neutral, which is always very expensive to do.
Yeah.
But the miners that seem to sort of survive multiple cycles are the ones that can manage that risk the best.
Yeah.
Because like and maybe some of that risk management is just like luck and timing the market with like capitals and sells and whatnot. But like
you got to love what you do in this industry. That's for sure. You got to be all about this shit. That's why we're having this conversation. But
right.
You got to be long the technology if you really want to have success long term. You actually have to care about what you're involved in, right? It has to be a passion.
Well, but even if you're cared about,
but also if you're a small scale, it might be a hobby, right? Like
you do like the build out of like CapEx at like the wrong point in time. Like you're still going to go bankrupt.
No
right?
doubt.
Like,
no, you're 100% right about that. You don't want to be building out at the peak of the market and buying equipment, all that stuff then. the bear markets is, if you haven't been building for the past couple of years, like what, you can build out when the market starts ripping again, and Bitcoin goes to an all-time high and, it pulls up, the rest of the market with it because there's more tension on the innovation and on the industry. I mean,
Yeah.
it's the wrong
So,
time. Yeah.
so like there's another way to think about it. So like one way to think about it as a miner then is if like you want to go risk on long, mine Quai. If you want to be risk neutral, at least to the degree that Quai Chi provides stability, mine Chi. So as the market becomes efficient and Chi's volatility like drops and now starts to like directly reflect your production cost, i.e. energy, if you get paid in Chi at that point, you're basically risk neutral in a fixed income business based off invested capital. You're just going to make 8% on your money or 10% on your money.
Yeah.
X asset pricing risk, right? Because like you basically don't have asset pricing risk because Chi follows your major input cost, electricity. So then you basically can mine and not have asset long risk. So maybe miners who don't want to go spec long a token can just mine Chi and then just sell Chi at your like marginal profit and be like, I'm perfectly risk neutral.
Yeah.
And the speculators will manage like the aggregate flows and supplies to make sure that given the capacitance and the demand, that these things still like converge back. So they might be the ones that are like taking the Chi that the miners mine and converting it back to Quai to like get back to market equilibrium point. But like all of the tokens could technically be mined in Chi, and that's fine. So as a miner, you don't have to be spec. You don't have to worry about arbitrage. You can just mine and be like, I want to be risk long. I want to be risk neutral.
Yeah.
You could just simply make that choice. Now, if you want to get a little bit more sophisticated, you can say like, I see there's a spread. So like I was on Chi, but like I know the spread's going to close. So like maybe I'll like run some Quai for an hour, vice versa. And then if you get like a little bit more sophisticated, you could get to the point where you're like, I know that we're going to have some like really hot weather in August. And I know the majority of the hash rate for like Quai or like 30% of the hash rate's like sitting in West Texas. And I know they're going to go through a curtailment event and I know the hash rate's going to drop.
Yeah.
Therefore I should like mine some Chi in anticipation because I know the exchange rate's going to drop when that like curtailment event happens and I'm going to be able to get a better pricing on Quai in a Chi denomination.
Wow.
So I'm going to like save up my hash based off expectations of weather in Texas. So it goes from like the very simple thing of like just mine what you want to be risk on or risk off.
That's fascinating.
To what's the weather in Texas in 2 weeks, right? Like in all variations thereof. So it can go to like a very complex thing, but you can choose to participate as a miner at the level at which you want to participate. So if you're not a spec guy, you don't want to worry about weathers and pricings and supply shocks, demand shocks. Just don't do it. Just say you want to be risk long or risk neutral. And then that's your choice. And like, that's all you have to worry about.
So yeah, basically if you think the hash rate's going to go down, you want to mine a bunch of Chi because then you can, when that happens, you could potentially convert it to Quai at a you get more Quai for your Chi, right?
Right. So like if I were to mine Quai right now, maybe, I get like, 10 Quai per unit hash, whatever it is. Or I can, mine 100 Chi, but then, if the hash rate drops, right, in this basis, instead of getting, 10 Quai per 100 Chi, maybe I'm getting 12.
Yeah.
So if I want to be like risk long on Quai, I might still
mine Chi,
knowing that the hash rate's going to drop and you get that like adjustment in exchange. And you can get more Quai for it, right? So like, all of these things are possibilities.
Very interesting.
For miners. But there's always like simple choices to like very complex choices. So the simple choice is like, do you want to go risk long spec or do you want to go risk neutral? So like once there's a relatively liquid market, like that is your choice. And that's the only choice you have to make. And then, anything past that, you're starting to get into the speculative like arbitrage business. And if that's what you want to participate in, that's cool too, but you don't have to.
Interesting. This is the first time, you guys really, you put a lot of thought into designing the system. It is fascinating to see what the potential is for blockchain systems and proof of work systems. And, what I love about what you guys are doing is you guys are, you're testing things. You're pushing the limitations of what people have thought are possible with these systems. And I'm here for it. I love it. I think it's super cool. This is the first time I've seen a system where, you mine and it's like you don't get paid for 2 weeks, which I think is interesting. I mean, there is a like even if when you look at the classic mining calculators right now for GPU mining, it's like I feel like Quai it projects at a premium because a lot of people just aren't even. Some people don't even they can't take the risk of waiting 2 weeks to get paid, or there's just a lot of different factors, right? So it's interesting to explore and to look at.
I know there's some pools that are looking at attracting business with instant payouts,
Yeah.
and they'll like provide the capital and like take a spread.
Yeah.
So that's
Which brings me to my next question of liquid mining tokens.
That's going to happen too.
Yeah.
And that's going to happen imminently, actually.
I mean, I'm talking to those lithium guys. You want to talk about that a little bit?
Yeah. So okay, so this is like a whole story. So
this is a whole story. Let's hear it.
Yeah. So one of the issues that you have with GPUs is you have a very flexible market, which is actually also an advantage for miners too, because if you invest in this capital, there's a lot of other ways that you can use your capital. If pricing isn't what you want it to be for mining at that point in time, you can go do some like AI compute, render, whatever jobs. There's a lot out there these days that you can use GPUs for. You can even clear the capital out if you want it, relatively good market prices that are uncorrelated to the crypto prices, which is great.
Yeah. Right.
So it's a much lower crypto exposed business than some other things. There's a counter to that, in that the security of the network is slightly impinged because of the lack of capital.
This is the ASIC argument of like stickiness. They want to invest in infrastructure that's only for your network.
That's right.
Yeah,
that's right. But like previously we talked about,
I don't subscribe to that, just because like if your network shows value and demand and use, it'll naturally attract more security to match that.
Right.
It's kind of my thought from watching these systems play out for a long time.
So
that's why Bitcoin keeps growing its hash rate and has more hash rate.
Well, so I I'm like a very game theoretic driven person. Yeah. So the ASIC argument is indeed correct at some level. So like if I have sort of the requirement to invest $1 or $2 billion in capital, and I'm going to amortize that capital expenditure over 18 months. I am highly protocol aligned, for that amortization period. And because of that, the security of the network goes up, related to, the fact that investment has to take place, and that is redirectable or repurposed investment. So that's a positive for Bitcoin in many ways.
I feel like it is now. The argument is just like the process that you go to finally get to like where Bitcoin mining is now, like ASIC wise. Like if you look at a lot of these smaller networks, like Kadena is a prime example. Like there was only like one manufacturer, and like I was mining it with maybe like there was a couple other miners that had all these ASICs getting all the supply. I mean, like. That's extremely. That's like there's a very risky period when there's like 3 data centers or 3 operations that are basically providing all the hash for the entire network.
Yeah, that's very risky. But I would also say,
and
like,
the centralization of the supply of the coins too.
There's still, you look at the aggregate characteristics of Bitcoin, and if we're critical or mindful rather of what they look like, there are issues related about the number of producers, the economics around like how they sell and distribute, and what pools access and operate.
It's gotten better over time. Let's put it that way.
In some ways, it may continue to get better over time. But for right now, in a small system, there's many benefits to GPUs.
Of course.
Right.
Yeah.
The disadvantage is it doesn't have that capital stickiness, so it actually lowers the barrier to the cost of an attack.
But attacking the network.
Right. Yeah. So the way that we chose to counterbalance that is we have what we call locked mine tokens. Okay, so when you're a miner, you not only get to pick between Quai and Xi, you can actually pick your maturity duration, which changes your reward amount. So if you take
like I know this. Sort of like nodes of different so we have one node that's at this, and another node that's at this, and one node's 6 months. Or, I know exactly what you're talking about.
Right.
Explain that though. That's really cool.
Yeah.
I forgot about that.
So basically, what you can do is you can say, I just want my tokens now, i.e., in the 2-week maturity window.
Yeah.
Or you can specify 3, 6, or 12 months. If you specify 12 months, you get 25% more reward.
Yeah.
And those unlock at 12 months. And so what that does is it actually encourages the mining system to go capital long the token, which is
Yeah.
in the same way as an ASIC goes capital long Bitcoin,
I like that.
right? But we're doing it without the negative implications of ASICs,
Yeah.
which is cool, and the positive attributes of GPUs.
Yeah.
Right. So it's a mechanism that has benefit to consensus because it creates a more resilient, capitally intensive business,
Mhm.
which long term aligns with the protocol.
Mhm.
Now, the problem is not many miners can necessarily float for
Energy costs for that long.
12 months.
Yeah.
Right. So
There's real world constraints on that.
there's real world constraints, but so the miners may need to then seek capital, but that capital is still vested in the system, which is fine. So it doesn't matter if the miners hold that capital or somebody else holds that capital. As long as the miners are economically benefiting from that capital being the system, it still preserves that cost of attack property. If that makes sense. So what we do is we say, okay, we know that the miners aren't going to necessarily be able to front that capital for 12 months. So we have created this mechanism that allows you to mine your tokens to a contract, and then the contract can sort of create a bond, if you will. And then that bond can trade, and the excess interest or the excess money is then split between the capital that buys that bond and the miners that produce the bond based off the relative supply and demand of the locked mined rewards versus the demand for effectively which looks like staked capital. So in a proof of work system, we've created a system that uses GPUs but has a capital component to get security similar to an ASIC while also providing what looks like staked yield in the system, but it's actually doing it in a way that's enforcing the security of the system.
Yeah, it's fascinating.
So like it's a pretty beautiful construction.
Hearing you explain it it's like I do appreciate the thoroughness that you've had when you've thought through the economics and the game theory behind all this stuff. I think it's just fascinating. It's one of the reasons why I wanted to have you here to unpack all this. I mean, it's super interesting.
And then the other thing that it does is it attracts capital to the system, and then it like helps to create a DeFi system. So right now it's like still very early, as we say.
Let me ask you a question. I'm sorry, before you go on, I want to touch on this. Is this like, I spoke a little bit with the Lithium guys, and I think Hassam had connected me with them. What is the protocol with the bonding of all this stuff? Is this done at the protocol level, or is this a third party entity that's putting this together?
So the locked mine tokens are the protocol level.
Okay.
Us allowing them to be mined to a contract is also the protocol level.
Interesting.
But anybody can create a market that turns the locked mine tokens into some type of yield.
Okay.
So, and there's like 100 different constructions you could make there.
Okay, gotcha.
You could make like a managed fund construction. You can make like, a thing that, looks like, circulating tranches. You can make things that look like very specific numbered bond NFTs at like very specific durations. You could do like a spread. There's like a million different ways you could take the locked mine tokens as an input and create financial products. There's ways that you could do like strips on this thing. Like there's like, but once you have that primitive of locked mine tokens, the simplest thing that you can do is create numbered bonds. But from there, you could create like a million other types of things around yield products, depending on what like the market demands and you think you can create for that market. So like Lithium is just sort of the first person to be doing liquid mine tokens, which is allowing the locked mine tokens to trade in some wrapper. But anybody can participate there. So like if somebody wants to come in and like compete with Lithium, like 100% they can do that. If they think they can make a better form of a market and better financial products and levered yield products, like good for you, like go for it, right? So that's all X protocol. The only thing that like the protocol does is it locks them and allows them to go to a contract. That's like the protocol version.
Interesting.
Everything else on top of that is non-protocol.
Interesting. So say I'm somebody that just wants to hold Quai as an investment, and I think that, hey, the network's going to grow. I'm long risk. I'm long Quai. I think, hey, this is an interesting decentralized network, proof of work blockchain. I'm sitting on hundreds of thousands of Quai, for example, a million Quai, whatever. But I'm not going to touch it for 2 years, 3 years, 5 years, whatever. would it make sense for me then to turn around to convert that Quai into one of these LMTs or these liquid mining contracts, and because I'm going to get a yield off of that, which is
Yeah.
going to pay me more?
Yeah, absolutely. So as a miner, you would potentially, go, long by locking your mined rewards, and you could
Mhm.
just hold those directly.
Yeah. Okay.
And you could say, the proportionality of like capital that I need to cover my expenses versus like, what I can hold spec long term, you could
Mhm.
balance that.
Yeah.
If you're somebody that's not a miner and you're buying tokens, you would have to then go into one of these liquid markets and
Mhm.
buy that yield. But buying that yield with Quai on a contract still gets you yielded interest, which means you're
Mhm.
going more long. And then if people make, more exotic products, there's like
Mhm.
ways that you can do strips and like levered longs and like
Yeah.
leverage like with that yielding product. So there's potentially ways in the protocol where you could maybe go like 3x long.
Wow.
But it all originates by having that yield over duration. Like having like yield in the system, it's one of those fundamental components that you kind of need for a financial system, and you need a
Mhm.
way to discover like the natural risk-free rate, and that like is here, in the system. And so there's like a lot of stuff that you're gonna be able to build like very natively that actually makes sense because the origin of the yield makes sense. Um,
You
but
obviously decided arbitrarily, what the yield would be for each liquid mined token contract. Is there a way in the mechanism for that to dynamically adjust as people, you're saying 25% for 12 months, and then what is 6 months?
so it's like a normalized sort of yield curve. So
Uh-huh.
on like an APY basis, maybe it's like 20-ish% for 6 months, and
Uh-huh.
it's like 17 or 15-ish% for 3 months. Like it's
Can this change though dynamically based off
well,
of what's
so
happening in the market? People, if certain number of people are picking one, will the other ones change to reflect that to
so there's
kind of incentivize more demand to the other
there's
parts
like
of the curve?
there's like two parts of the market,
Okay.
right? So like the part of the market that pays out like yield to encourage capital for security, that's just like fixed
Mhm.
based off like what we thought was like a rational security yield like capital requirement to
Mhm.
like sort of reflect an ASIC like topology. Like that's where that number comes from.
Gotcha.
But there's in the secondary market, that yield curve bends and adjusts. So
Mhm.
if you're a miner and you lock up tokens and then you sell them at market, if the demand for yield is very high relative to the supply, you might go and sell a bond at a year that's 25% excess at a 20-point premium, right? And the yield only gets 5%, right? If there's more supply of the locked mine tokens than there is capital to yield it, or that balance changes, maybe you only make 5% extra and you're paying 20% to the yield.
Mhm.
And then in the middle, like once these are sold the first time, they can circulate as a secondary. So you can actually like make money or lose money by the change in relative yield of the product over time. So there's actually there's sort of like this protocol rate,
Mhm.
which is defining what the protocol thinks it needs to pay to get enough capital sink to get that security that we want.
Mhm.
But the secondary market is a discoverable liquid bond curve.
But so the protocol market though, that cannot adjust. That's set by you guys essentially.
That's just like set, and that's set
Is
for
that
the reason of trying to get a certain amount of capital into the system.
gotcha?
But how the rate evolves and changes over the curve is a market discovered mechanism, based
Gotcha.
off relative supply, demand, risk, perspective, et cetera. So like you could actually make money by trying to like play the change in the market discovered yield rate on these
Yep.
bonds. So like if you bought a bond and the sort of staked yield rate was 20% when you bought it, but there's more capital demand in and it closes to 10%, right? You can actually make premium on your bond over what you paid without holding it to duration.
Yeah.
On the same token, if you bought at 10% and it spreads open to 20 and you want to get liquid, you could sell that bond at a loss, just like yield in like liquid bond markets and any other thing.
Yeah.
So you're actually creating like it's very interesting to have
It
like
is
a
interesting.
proper native protocol yield rate in the system that
Yeah.
like is actually doing something meaningful.
Uh-huh.
Yeah. But at some level, like you want an emergent property of the cost of money, like in the system, like you really do, to create a monetary system. And that is a downstream effect of having duration. So by introducing duration, we've made it so that interest rates exist, and then the market can leverage that, and then also leverage products against that. So like there's so many implications like once you introduce like a real market discoverable exchange rate.
Interesting.
Or sorry, interest rate. Yeah.
So if I hold one of these if say I mine this contract, does it kind of like locks, and then at the end of it, when on expiration, it'll release Quai plus the yield? I mean, how does that work exactly? Or is it just slowly dripping Quai?
No. It's just at duration.
It's just at duration. So once it hits duration, then it will,
Yeah.
If it's 100 Quai LMT, right? So it'll come in as a token of a representation of a Quai. Or I mean, how does that? What does it show up as in the thing? Like, what does it look like on chain? Like what? Like
so in LMTs, we did a poor job naming here. So there's locked mine tokens and there's liquid mine tokens, which is like that was dumb on our part. So in the case of a locked mine token, you just do your Coinbase, and you'll see that Coinbase. You just won't be able to spend it. It's just locked in the same way that like there's a locked token like in your wallet. So you're like, okay, this is locked, and
but there's no way
number like it unlocks and I can spend it.
But is there a way to differentiate that from other tokens that are completely unlocked? Is there any?
Oh yeah. So like it'll show up as a locked asset like in your wallet. Like you'll be like, this is your balance. This is like your locked balance.
Okay, gotcha. And then within that lock balance, if I'm doing 6 month unlock, it's
like so like in Pelagus, we don't like have that degree of UI, but like if you go to Quai scan, like you'll see,
should put that into Pelagus. That'd be well worth it. It'd be cool.
But potentially, I think to have like a good UI UX, like it probably would be like a better extension of Quai scan, because like there's probably a lot you'd want.
Yeah. Okay.
There to like manage that. But yeah, I would actually say in terms of like competitors to Lithium, that type of tooling would actually be like a very value added competitive advantage, for people, depending on how you package these things, how you represent these things, how you like construct the market, which tools you have to figure out like where there's opportunities along the bond curve that like aren't normalized. Like there's a lot you could do from a technology standpoint that's actually just incentivized, because if you want to like make money in that business, like there's a lot of money to be made.
Yeah.
And the better tooling that you can provide, like you're going to be able to like take points on that. So
interesting.
Yeah.
Interesting. Let's talk a little bit about the work shares thing again. I know we talked about a little bit of this in the last episode, but just really quickly explain why you guys have work shares and how it kind of solves that traditional mining pool problem. Just very, very briefly again, go over that one more time. The work shares.
If this is our only foray into work shares, we should probably go a little bit.
Well, we did have a foray already into work shares in episode 2, so let's. I don't want to go too deep. Talk about whatever you want. We got all day.
So work shares actually do like, I believe, 5 things for us in the system. From a mining perspective, what they do is they allow us to have more payouts per block, right? So on average, there's 8 work shares in a block. So, and we have 5-second blocks. So we already have like pretty consistent payouts. But with work shares, we have 8 times more consistent payouts, so to speak. So even if, we're like a very big network and you still have sort of 1 GPU, you might still get paid like every 3 or 4 days.
Yeah.
So the inconsistency in payouts relative to your hash rate doesn't require you to go to a pool. That's like one great thing work shares provide. Because like if I only have one,
you're doing what the pool's doing, like at the protocol level. So it's super interesting. Yeah.
Yeah. So like if I only have like one S21, if I don't have that payout like in the protocol, like if I have one S21 on Bitcoin, like I have to be in a pool. I have no choice, right? Because
unless you got a bid X and you're just playing the lottery.
Well, you're playing the lottery at that point. But if I like actually want to participate and like do revenue and not just fucking lotto tickets, like I have to be in a pool,
of course,
at this point.
Yeah.
Right. So like having very infrequent payouts creates a economic force towards centralization. So by having work shares, we basically said in the protocol, there will never be an economic requirement to participate in a pool. Like there you go. You'll always get payouts. So you don't have to go to a pool.
Yeah.
That's what it does for miners. It also helps consensus because it gets us more measurement of hash per block. So we have a better statistical understanding instantaneously of what 51% of the hash rate does, so that I can actually say in one block, I know that 51% of the hash rate is voting for that block, which allows us to get better sort of confirmations. So in a system, to sort of lower the variance in a work-based system, you need at least 6 samples. So we set like the number of work shares, which you'll expect an expectation, to 8. So typically in any given block, there's enough samples in the block to know that 51% of the hash is voting for that block.
Interesting.
That's the other thing that work shares do. Now, another thing that work shares do is they actually create a mechanism by which transactions can efficiently propagate in the network. So and this is like Hashcash, by the way. Hashcash was this thing by Adam Beck. It's one of like the predecessors to Bitcoin, right? And what it was saying, I can prevent email spam if I have a protocol which requires the sender to do a certain amount of work to make that like an email I'm going to look at.
I mean, yeah, this was like the basis of the whole idea of proof of work. It was that, preventing spam, because you actually have to provide some actual energy before you, like, it's a small amount. Like, it won't really affect you. You won't even barely notice it. But if a spammer is sending 5 million emails, he's not going to be able to do it because he would have to provide that little bit of energy for each one.
Right. That's right. So that's what Hashcash did. And what it does is it basically makes it so that there's expense to send messages, right? So you can't spam the system for free. Yeah. So one of the problems that you have is if you allow messages to circulate in a peer-to-peer network, you potentially have to have secondary mechanisms of spam filters, right? You potentially have to hide something behind a Cloudflare, right? So like if I'm a Bitcoin node and I'm providing service, but I have to hide behind Cloudflare, like I'm not technically decentralized because like I'm dependent on Cloudflare because it's protecting my node from spam. So like this is not good. Right. And the messages that circulate in Bitcoin, which aren't worked, are the transactions. So in Bitcoin, if I wanted to, I could send a transaction out, and as long as it like met the pool minimum of sats per byte, like it would go through the network. Once it went through the network, I could go back to the network. I could increase my price by 1 sat per byte, and I could rebroadcast the message, and it would go through the network again.
You'd have to pay though, right?
No, I haven't paid yet.
Oh.
It's an RBF. So I can just RBF this guy like a million times, right?
But if a block gets mined and you've broadcast
then I've paid for it.
Yeah,
I've paid for it, right? So like I have this de minimis like amount that I'm going to have to pay for one transaction. But in the interim time, I could potentially make that transaction circulate around the network 2,000 times.
So essentially what you're saying is you're just spamming the mempool.
Yeah, I'm spamming the mempool, and then if I want to like keep spamming it, like I can go from one transaction to I can use one account to go to 2 accounts, to go to 3 accounts, to go to 10 accounts, to go to 100 accounts. Yeah. And every time I clear a transaction, I'm only paying a cent, but I'm causing in each one of those accounts that message to have to propagate like thousands upon thousands of times because I'm RBFing it.
It's kind of like a DDoS for the mempool. Is that what you're kind of
right?
And it sounds like.
And so what people will do is they'll put their mempools behind firewalls, but then we lose the decentralization property because like it's behind a firewall, or you just like tolerate the fact that you're getting RBF'd and you're not getting paid for each message that you circulated, right? So like it's
but nodes aren't really getting paid anyway unless you're running the miners that go with them, right? At this point, you're kind of just it's altruistic, in some ways, right?
Yeah, but potentially. So the transactions are like the problem in the system, basically, right? Every other message that goes through Bitcoin is worked. It's the transactions that aren't worked. Right. So what we do with work shares is we actually use that as the mechanism by which you propagate groups of transactions. So in our system, if I'm a trusted node with you, I can say I am willing to circulate singleton transactions between our nodes because like I know you, you know me, we ain't going to spam. But for us to broadly circulate the transactions, they have to be in a work share. Well, actually, it's technically a share. So there's something below a work share. It can propagate in a work share, it can propagate in a block, or it can propagate in what we call a share. So we allow like 100 shares per block. But it means that to propagate a transaction openly in the system, you still have to have done some amount of work on it before it propagates so that you can't spam the network. So in this particular case, if I were to try to like RBF in a meaningful way, I would actually have to have a meaningful representation of the total aggregate like network hash rate to do it. So the other thing that like we do with work shares or shares, which is the sub work share, is that we use it to incentivize this concept of what we call a transaction pool, and for that pool to then aggregate unique sets of transactions together and propagate them openly in the network in a DDoS protected way. So because it incentivizes transaction pools, it actually makes it so that the pools want to have unique sets of transactions that propagate, and they want to have multi-sets. So instead of like doing singleton propagation, it forces you into this system where it's like, I want to be a pool and I have to find a share. So what's going to end up happening is I'm actually going to only propagate when I find a share. So I'm going to get 10 transactions to propagate together instead of 1. And so that makes the transaction propagation 10 times more efficient. So not only does it DDoS protect the network, it also makes the propagation around the network much more efficient, right? Like potentially like 100x more efficient. And that's actually one of the limitations as you start pushing TPS numbers. The primary imposition of cost is the transaction propagation. So if you're going to try to go like, and that's one of the reasons this like kind of doesn't matter for Bitcoin because it's only doing 5 TPS. But once you say like, I want to do 1,000 TPS, suddenly that like bandwidth and service requirement of trying to get those transactions around is like the problem. So if you create that very mild incentive that I can't like spam this system and I'm incentivized to kind of group them together through these like transaction pools, you can increase the efficiency at scale somewhere between like 10 and 100x on the propagation like characteristics. So that's 4 things that they do. And then there's like a 5th one. Let's see if I can remember what the 5th one is. But it's very cool with work shares, like in just work generally. Like if you use the system, there's like all these cool things that you can just like slightly tweak, right? And so like what did I just describe in some ways? There's like a very interesting thing that happened there. And this is maybe like a more fundamental thing with like what we do at Quai in terms of like how we design the system. It's about markets and it's about market design. And if there's a resource that's consumed, there should be a countervailing market against the resource. And if you don't have a market,
if you don't do that,
like it means that you have a problem, and you're just saying like how like subtle is that problem versus like,
I mean,
how altruistic is that thing? Like, so for example, like
leaving it up to,
we've DDoS protected the network, but like, let's say that there's like a ton of transactions like wanting to get in. And let's also say that like some people want like very lively inclusion of those transactions, meaning they don't want to like wait the extra like 3, 4, 5 seconds. There's an incentive for merchants to actually start running into pools. And there's an incentive for hash rate to find merchants. And there's an incentive to put these things together. So there might be like a middleman that's trying to figure out how to like aggregate hash rate together into like a trusted shared pool and find merchants that are going to ingress those transactions in the pool. Because if you can do that as a miner, you want to participate in that pool because you get a first look at the transactions. Now, once you like find a work share though, you want to transmit that thing as quick as possible because you get paid for those work shares. But to transmit that, you have to include the data. So that's the 5th thing that we solved. There's no incentive to propagate transactions in Bitcoin. If you were like a perfectly rational 0-day miner, you would not share any transactions. The reason that you share transactions is because if you don't, the value of Bitcoin will drop. But that's like a mid to long-term incentive. On a single individual point of view, you should never share a transaction.
I'm confused about what you mean. Why would you not share like why would you
because
not
if I don't share the transaction, it means you get to take the fee.
Oh, I kind of see what you're saying. You're talking about in the mempool when it comes into the mempool. If you get it, if you can see it first, or just not even share it to the mempool.
Let's say I submit my transaction to the mempool, and let's also say that like I included a 1 Bitcoin fee. Are you going to share that? No, you're going to be like, no, man, I'm just going to fucking sit on this guy and hope he doesn't submit it to anybody else because, like, I want that 1 Bitcoin fee. So, like, that's...
But it gets submitted to everywhere, right? I mean...
No, it depends on how you write your mempool. So, like, there's no requirement to run core software. So, like, in the rational setting...
Yeah, I mean, there's no requirement, but, I mean, 90-something% is run on core.
Well, but...
Running core right now.
Kind of.
What is it, 96%?
Yeah, I mean, if you get into it, they're running core, but like they're not. Like,
what do you mean?
People make modifications to core that they like run in these pools to do selfish mining. So like, if there's a big pool and they see a big transaction come to them, they don't broadcast it. Like this was written. Aviv Zohar, which was one of the co-authors of Ghost, actually wrote about this. It was one of his first papers that he wrote, like in blockchain. He's actually one of the guys that also like did Caspa. Ghost DAG. he wrote a paper called The Red Balloon Problem, and it's specifically going over the fact that there is no incentive to broadcast transactions. So by creating work shares, we literally accomplish 5 things, and one of those is solving the red balloon problem, which is because the transactions end up getting included in work shares, and you want to include it in the work share because you don't know a priori if it's going to be a work share or a block, and you also want to get paid for work shares. Even if I give you a 1 BTC like fee, if it goes into a share, you're going to propagate it because like you're not going to hold it back because you want to get paid for the share. And your share is going to be invalid if you don't propagate the transaction. But you also have to include it in the work share, because if you don't include it into the work share, you're potentially not going to find the block. So like all of these incentives line up. And if you can't like include it to find the block, it means you can't take the fee. So to be able to take the fee, you have to propagate it, if that makes sense. So like these sub shares force propagation of the transactions, so you don't get this selfish problem of taking of transaction fees. You get the DDoS protection problem. You solve the problem of having to like get more consistent payouts. There's like a million things that these things are doing for us in like this very elegant way, I guess.
Yeah, I mean, I think, you know, obviously a lot of these things are abstract and most people don't know about some of these little issues, and Bitcoin works fine despite, you know, despite little potential bugs or issues around the margins of certain things that might not be 100% optimal.
Well, I mean, in some ways,
but I like the way you've thought about it and are solving these little issues and malincentives, and it's honestly fascinating. It's honestly fascinating.
So some of these things don't matter for Bitcoin.
Yeah.
Like they're there, but they don't matter because
they matter to users and people.
Yeah, they don't matter because of the regime in which Bitcoin operates, right? Like if Bitcoin isn't running at like very short block times and like having a naturally high uncle rate, like some of this stuff doesn't matter.
Yeah.
If Bitcoin isn't like seeing huge fee disparities like go around, this does actually happen though. By the way,
a little bit,
like people do withhold transactions, but
I would say it's pretty rare though. I mean, I would say it's rarer than not, and we're talking about such a very small, minute situations that occur, not often, not all the time.
I would say it's a plurality of hash that does this.
What do you mean a plurality of hash?
I would say the majority of hash that is represented in the network is doing this.
Really? Wow. Yeah. I'd have to look.
Yeah. So like if you look, like I guarantee you, Foundry is doing this. Guarantee it. So like if they see a transaction that comes in above some threshold value, like over the expectation value of like what the prevalent like Cypherpunk'd fee is, I guarantee you they hold on to that transaction for some period of time before they propagate it.
Interesting.
Guarantee it. Right. So yeah.
When people are broadcasting these transactions though, why would they just there's got to be a way for the user to broadcast it to multiple things at once, not just one.
No, they potentially could. So like if you're a node and you're submitting your transaction through a node, you're potentially going to submit it to multiple people.
Of course, yeah.
But most transactions that are submitted on the Bitcoin network don't go through individually operated nodes. They go through one of the index providers.
But wouldn't the index providers have an interest in keeping Bitcoin honest? And, you know, obviously the network there.
I mean, are the people submitting them paying for the APIs?
Yeah.
And is the value that they're paying for those APIs greater than or less than the value that they're taking on the premium on the transaction fee? Because like what's going to happen is like depending on like the answer to that question, they're going to do one or the other, right?
I mean, I think there are plenty of honest people in Bitcoin that won't do that based off of purely morality. But I hear what you're saying. It's definitely a potential exploit of incentives that, you know, might just.
I think there's some honest people. I think you're one of the more honest ones at the end of the day. But when you get to scale and the size of money that we're talking about against these optimizations, they would be completely negligent to like
you're saying
shareholder to not do these.
You're saying they have the fiduciary duty to.
I would say they have a fiduciary duty to withhold blocks.
Yeah.
I would say they have a fiduciary duty to withhold transactions that have some fee over some
interesting
deviation amount over the average like sats per byte.
It's an interesting take.
Yeah.
Before we close out this episode, I want to look over the tokenomics. So we're kind of talking about dual tokens and the token situation, and you know, Quai and Chi.
But I just want to be fair to Bitcoin. Like this doesn't like hurt the system that badly.
Of course,
Like
we're talking about an issue that's like really far out of like on the margins. That's
well, my point is it exists.
It exists, yeah.
And I would say that the people in the system do indeed exploit these mal-designed incentives, but from like a user outcome perspective, you don't normally see it.
Yeah, you don't.
The reason that this is like important as you scale and as it becomes important as you're like, I want to do 1,000 TPS.
Yeah.
It becomes important when you say, I want to do 5-second block times.
Of course, yeah.
So in the Bitcoin context, these are like not that big of a deal.
Mm-hmm.
It exists. They're exploited. It doesn't create that much of a negative impact on the system. But as you like tighten up the requirements of the system, if you don't solve these problems, nothing works, right? And so the reason that we solved it isn't because like it's like a catastrophic problem for Bitcoin. It becomes a catastrophic problem as you tighten the requirements of the proof of work system. As you say, I have to do more throughput. I have to get these transactions to propagate. I have to get these tighter block times. You can't like not solve these problems. You have to solve these problems if you want it to work.
I see what you're saying. Yeah.
Yeah.
All right. Let's talk about the Quai's tokenomics a little bit. Let's talk about your Genesis allocations. What is, you mentioned that there's no hard cap to the final supply, although it does deflate over time. And, you know, that can kind of change based on the demand of the system, where it can kind of like, you know, in times of high use, the inflation rate will kind of go up a little bit, but over time it's going deflationary. Is that, am I understanding that correctly?
Yeah. So when we look at mining and we look at like mining as a distribution mechanism, and we look at trying to create a system that's money, there's a balance between rewarding early adopters and achieving a good Gini coefficient.
Yeah.
So if I basically said, on a very extreme case, that half the supply like gets emitted in the first like 3 months, that's going to create a very bad Gini coefficient, because there's only going to be like, you know, 20 dudes that like knew about the system. They're going to like have all the tokens.
I mean, to be fair, you guys had like fucking 5 test nets. I mean, I'm exaggerating a little bit, but you know, this was a project that was not just like launched immediately. There was a lot of notice. But I hear what you're saying. You're making a very valid point.
Well, so the point is like, if you want to become money, like one of the properties that helps adjust like adoption is some degree of like balance between rewarding early adopters and later adopters. Like there's just a balance that you need to strike. So like if we took the Bitcoin example, you know, this was a different time period, and obviously it wasn't as well known when this happened, but right, the fact that like Satoshi was basically like, I'm gonna not spend those tokens because he had like 1 million tokens by himself was like an issue around the growth of the network versus the issuance. Yeah. And you know, he selflessly corrected that. So like that was positive, but that was his recognition that there was like a problem with the Gini coefficient that like he proactively adjusted, right? So like that's like a thing, right? And so there's this balance. And if it's too like heavy in favor of like the very first adopters, then like the people that come into the system later are going to be not as incentivized to come in. Yeah. The other thing that you want to consider too is you want to like have a deflationary curve. So like in Bitcoin, you had the halvenings. In tokens that came after Bitcoin, people said, well, there's a discontinuity in the halvening process. So it kind of looks like this decaying exponential curve. Great, but these discontinuities create disruption of stock to flow, and they create super cycles with booms and busts. And we think that those super cycles are bad for net adoption, because it means that some people get like burned depending on like when they come in. So people have to like time entries, which sort of aggregately retards growth. I would likely prescribe to that at some level, certainly at this point in time. I think potentially like 10 years ago, like some of that like stock to flow stuff is actually like pretty beneficial. I
think so too. I think it created like viral marketing, and you know, control, like the supply shocks actually helped, you know, and I think this was by design. This was intentional, was to draw attention to this and say, hey, look, you know, price is going up because, you know, supply got shocked, and the demand, even if the demand raises, like remains the same, at some point, you know, that supply shock filters through, and then you've got this parabolic price movement. And, right. You know, I think that's viral advertising for your asset. And, you know, it's like it's like this crazy, like innovative innovation in, you know, sound money and this, you know, freedom money essentially, and it's all wrapped up as like a get rich quick scheme. I mean, that's kind of like what it looks like. And then once you go in and you kind of peel back that onion a little bit, you're like, holy shit, this is amazing, right? Like go down this rabbit hole, right?
So I think it was like a good idea.
And then as time goes on, like right where we're at right now, it's like, I think going forward, the halving is going to have
less and less effect.
Less and less effect. So 8
Yeah.
years from now, 12 years from now, it won't be as much of a effect.
And I think like given the adoption, like it's worked out reasonably well.
Yeah.
But I guess the statement that I would make today, like given the awareness of these systems,
best performing asset in all of human history.
Yeah. But the statement I would make is today, I don't think that having those shocks to the system in a newly launched asset, which is an alternative to Bitcoin, is like net beneficial. So you want a continuous curve.
I like the continuous curve as well. Personally.
Right. So you want this continuous curve. And then the other thing is you don't want it to be arbitrary to the growth rate. So ideally you want it to be deflationary, but you want to be adaptive, meaning part of the aspect of proof of work is that you want to get good distribution of tokens, but you don't want that distribution mechanism to have to be arbitrary relative to the growth. So if growth comes in for whatever reason, we want to like why this thing is getting adopted, like actually increase the inflation rate, because that is the time at which you can like put more tokens into market and do it in a way that's fair, that's like price stable, like a lot of like good benefits. Now,
it's mathematically set, I guess, is the argument. Personally, for me, like I've said before, store of value wise, I'd rather have that absolute scarce, know what the inflation rate is perfectly over time. But I think what you did here was you programmed it, so it's like it is kind of it's fair.
It's a little bit more fair.
Yeah,
like that's kind of like how you wanted to program it. So and it's adaptive to growth. So the reason we say it's deflationary is because it's programmed so that the value of the network based off of Metcalfe's law is always superior to the emissions rate of Quai. So Metcalfe's law is n log n. The emissions of Quai is just proportional to log n. So what that does is it basically says the amount of emissions can grow, but it always should grow at sub the demand is basically the statement. So if we are sub demand growth, it always means I'm in a deflationary environment. So even though the net or the absolute supply is going up, the supply is going up less quickly than the demand.
Yeah.
And so by attaching it to hash rate and using log n against n log n, we kind of guarantee that we're always sub growth, but it also isn't deterministic in time, meaning if it decides to grow tomorrow, if it decides to grow in a month, or if it decides to grow in a year, it's adaptive to when that growth takes place. And then if that growth happens and then like slows down, it's also adaptive to the slowdown and it's adaptive to the pickup. And then the idea with that is that as somebody that's coming into the system, you don't have the same like issues of price exposure that you would in a cycle. So like if you came to Bitcoin and you're like, fuck yeah, man, like I'm coming in and it's like the top of the cycle, there's like FOMO and like the noobs like always come in and they always like are buying like the top. So like it's good marketing from that perspective, but it's bad marketing from the fact that like they get burned until the next cycle, right?
It's part of like the holy rights of becoming a Bitcoiner,
right?
Really,
yeah, you gotta live through the cycles, right? But the thing is, ideally, as like an educated investor, you actually have to time your entries, right? Because of that sort of implicit stock to flow, if I come in at the top, like that's a very bad time to come in. So like, I'm not buying, I'm not going more long at 100,000. Like you're going long when it's at 20,000, right? Like as someone who's more sophisticated, like that's when you're going to deploy new capital, right?
I mean, again, this is why I teach dollar cost averaging to our meetup guests. And I mean, anybody that we interact with, from majority of people, it's just dollar cost average. I mean, so take a 10-year time horizon.
Effectively what's happening in Quai is we're trying to like remove that shock to the system so that whenever you come in is like a good time to come in.
Yeah.
So like as long as the system keeps growing, like it's beneficial for you, but because there's this shock of stock to flow, your timing is much less important because it's always sort of adaptive. So like it's meant to go up, but it's meant to go up in like a much less jagged or discontinuous way.
Yeah.
And it's meant to go up dynamic with growth. So like if growth like, starts happening in a month and it's like 10%, great. It like adjusts to that. If it turns into 50%, great. It adjusts to that. If it turns into 5,000%, still adjusts. So like it's like very sustainable in terms of the emissions model to growth, so that we get a good Gini coefficient, but we allow the system to get adopted as fast as people are willing to adopt it. So that's like why we did it that way. Because like functionally you're trying to like run an S curve, but you want that S curve to happen as fast as humanly possible. And so if I like let people come in all the time, and like it's an okay time to come in all the time, then like it can just go as fast as people are willing to come.
Interesting. I can definitely see you've thought through the mathematics behind all this. Let's talk a little bit about the initial issuance and look at the supply chart here. Paul, can you make that graph bigger? The picture we're looking at here. Can you like zoom into that graph? Yeah, maybe pull it up. I guess just talk me through the initial Genesis Quai distribution. It looks like the first 7 years you kind of have it modeled out here, but it can change within that period, right? This is just
so this is just the Genesis. Could you move the OBS a little bit for me? Is that possible?
There you go. Perfect.
Yeah. So that's just like the pie graph, and this is showing like how the unlocks go.
Okay, so this is the initial 3 billion and how you guys did that,
right?
But this is for the Genesis, and then after this, all of the, because this doesn't include mining, does this?
This doesn't include mining.
So this is like the initial, I guess, what you call pre-mine and community fund and exchange liquidity, et cetera, et cetera. Why don't you walk us through each one of these things and kind of explain what this is? You can start at the top with the testnet and earn program.
Yeah. So the testnet and earn program, like you said, we had 5 testnets. And those, were incentivized testnets. So like we had real miners that were running nodes that weren't free and GPUs that weren't free.
That is true. There was real cost with that. I'm still waiting for my tokens to unlock.
Right.
What's going on with that? Tell me about it.
Well, and the last testnet was like an economic testnet where like the tokens were actually like trading with like some perceptive value. But basically that allocation goes to that participation that happened over the testnets. And then the earn piece of that was there were like different. Is the earn piece of that, or is that the?
It says testnet and earn program in that 5.3%.
Sorry, ecosystem. Yeah, and earn. Okay, in that 5.3, and some of that was also there were like tasks like social media type things, and there was other non-mining but like activities that you did to like earn points that turned into Quai, right?
Gotcha.
And that's like what that piece is. Exchange liquidity, that's basically
like a very small little a nugget there.
But basically to fulfill the needs of market makers. And then you have team. So that's everybody that was like an employee, like got allocations there. And then you have 2 different funding rounds for investors, seed 1, seed 2. Obviously that's pretty self-explanatory. People that gave us money.
How did you think through that? How did you decide how much to accept? What are your thoughts? I mean, there's something extremely special about like an immaculate conception, right? Like of what Bitcoin was, where there's like even Ethereum had a pre-mine, right? So like Bitcoin stands alone on that, where there was no pre-mine, there was no selling to investors, nothing like that. How did you guys think through that? How much to do? How it would affect the inflation of the coins, and how that would affect the markets long term? I mean, how did you guys pick your partners?
Yeah, I mean,
stuff like that on that.
That
and think about it.
No, so we had ideally better partners, right? Like Polychain and Alumni Ventures, who are longer term sort of engaged participants. But in terms of the amount that we raised like the absolute minimum that like we needed to raise to like get the thing done. Right. If you sort of like unpack all of this stuff here, there's a lot, right? And I mean, none of that was free. When we were testing these things, like we were having GCP bills to be able to test this of like 30, 40K a month.
Of course, yeah.
Right. Like, so there's like real costs and,
salaries. And
we had salaries of, 20, 30 people, right, to like cover to develop this thing.
Yeah.
But we basically raised as like little as we could at the highest valuations that we could get people to agree to get to market. Like that was like our strategy. So everything is like a negotiation, and you're trying to maximize the benefit per dollar, so to speak, that you get, or the benefit per token that you get.
Yeah.
And that's how I think about like all of these things. So like if we talk to a project and they're like, oh, it's gonna be this much, I'm like, no, it's not. Like, we're gonna negotiate that, obviously. Or they're like, oh, we should get this much for our grant. I'm like, demonstrate to me how you're getting value for that. If like a KOL comes and they're like, oh, like we want to do this, and I'm gonna like put what I think is a beneficial number that we're gonna get back from it, or what like is a market like, value number. And if like that doesn't match up, I'm gonna be like, cool guys, like we're gonna pass, because like you don't want to pay price premiums, because what you're trying to do with all the tokens is you're trying to always create more value than you're putting out. Like every token you should think of as like a personal dollar that you're spending. And everything about this like whole design, like if you think about it, what you're trying to do is you're trying to suck in as much capital as quickly as possible by creating the greatest amount of value and utility for every token you put out. That is like the underlying guiding strategy of the entire thought process. Like, are we perfect at that? Probably not. Are we getting better at that? I think so. But like that is the idea. And if there isn't like commensurate value coming back, don't spend the token. There's like no reason you have to spend it. Like if we have the foundation tokens and at some point we're like, hey man, these aren't needed because like we've grown and like there's awareness and like we've done the integration projects and like we have good acceptance at retail, fucking burn that shit. Like you don't want to put that into the environment if it doesn't need to go into the environment.
Yeah.
It is, but at the same time, when we talk about like the foundation and the incentive tokens, it's a recognition that we exist in an unfair world and that you need money and capital to quickly co-opt existing power centers into your system. So saying you're going to come in with like an immaculate conception today,
like, no, I agree with you. I mean,
doesn't work.
That's why Bitcoin is so special. I mean,
yeah, for sure. For sure. But I guess like personally, I would love it if I didn't have to have the complexities,
of course,
like foundations and allocations, and you could just like mine the thing.
Yeah.
But I don't think that's the mechanism by which you get the.
You wouldn't have been able to build you wouldn't be able to build all the stuff into it that you built into it, right? I mean, like that's that requires obviously tons of time, energy, thought, development, and there's real world costs with that, of course.
Well, but it's also about like trying to accelerate the path to adoption, right? So like the statement of like, why do you need a foundation? It's because I need to have an entity that can go and create the proper incentives to get like the integrations and the payment partnerships that you need, and saying that you're going to get that out of, like mining and like some community coming together to do that is, I think, a suboptimal like path in duration to getting adoption. And so like that's why you do those allocations. And if those allocations ultimately aren't needed, you just burn them.
Yeah. What you have development company 6.1%, if I'm looking at that correctly. What is
so that's dominant strategies.
Okay.
So that's like the amount that remains within like dominant strategies to like keep funding development.
Okay. So that's separate than team. I mean, is team?
No. Team is like incentivized like personal like tokens. So that's like when you come to work, like you get a token grant. That token grant vests over 4 years on a 1-year cliff.
I got you.
Right.
So that's like an additional. That's kind of like stock. You like if you think about it, it was like, hey, in development company that's paying the salary of the people like to live, and then team is kind of like an allocation that says, here is like your stock shares and this, and here's your ownership in this protocol.
That's right.
Okay.
That's right.
All right.
Right.
Cool.
So the 6% is like you sell those to investors or like potentially like locked OTC deals to like keep funding development as development is needed. Right.
Okay. Let's see here. Ecosystem and community. What does that mean? 23% ecosystem. Can you explain that?
Yeah. So that is meant to be the incentive structure that like isn't spent by the foundation, but is like allocated by the foundation. So let's say we get a deal and we want to get like a Walmart to like accept our token, but like the Walmart kind of like needs a taste. Like you're going to give them a taste from that like bucket.
Okay.
If that makes sense.
So you're going to essentially say, hey, you're going to give them a taste from the ecosystem and community bucket. You're
That's
basically
right.
going to say,
Or
hey,
if you have a project that like, Chainlink, and you're like, Chainlink wants to come on, but like they need a taste, like comes out of that.
Okay, which is separate than the exchange liquidity. Or would that be something that you could also pay the exchange to do that, or would that only be under the exchange liquidity program? Like,
so exchange liquidity is meant to be for market making.
That's what I was
so
trying to get at,
community incentives would have to come out of, exchange like.
So say like
payments.
Binance was like, hey, we'll list you, but we want $100,000 worth of whatever, of
that would
Qi or Quai.
that would come out of that.
This is Quai specifically, but that would come out of the community, the ecosystem and community bucket to pay for the exchange listing. Okay.
Yeah. And if it had to bleed over, like you could bleed it over into the foundation, but the foundation is meant to be like grants and like needing to pay for infrastructure and development and whatever that may look like. And then I guess if that's not needed, you either burn it or you potentially spill it over if you need more in the ecosystem and community. But like effectively what you're saying here is like we live in an unfair world, and there are like people that have power, and like everybody needs a piece, and if I give them a piece, like we can get adoption more quickly. Like that's literally the point, right?
So for the foundation, who decides who's on the foundation, who is on the foundation? Is that like paying the people on the foundation, or is that more just like
no,
specific?
So that isn't like to. I mean, ultimately that will cover salaries, but like the salaries are going to be like market salaries, right?
Gotcha.
So like it's a regulated foundation, right?
So it's a separate entity, even it's its own actual.
Yeah, it's its own. Is
it a nonprofit?
Yeah, it's a nonprofit.
Oh, interesting. Okay, cool. So how do you guys decide who gets to be on the foundation? Do people vote on that? Or do you guys just align? Okay, these are the people on the foundation right now, and that can change in the future.
Yeah. So there's like a set of directors, and those directors can like change over time.
Gotcha. Okay.
But the point of that again is really just to facilitate like grants and development, and if that becomes unnecessary, like the foundation is structured to wind down.
Gotcha.
Yeah. Like it's specifically written in the bylaws that like if we decide to shut down the foundation, like all the tokens like will burn. Right.
Okay, interesting.
Like in the docs. Right.
Wow.
So I see the foundation as a liability, not an asset. I mean, it's an asset for the network.
It's supposed to do,
but it's a liability for me.
Yeah. Okay.
if that makes sense. So
interesting.
Yeah. I mean, both the foundation and those community incentive buckets, asset for the network, liability for me is like how I view those.
So this is the emission curve for the first 3 billion tokens over 7 years, kind of how they're released. Paul, are you able to pull up the mining supply inflation? Is there a chart that kind of shows how that? I mean, obviously that can kind of change, but is there a good chart that kind of shows how?
So these were kind of predictions based off like growth rates that we took from Bitcoin, and we basically said like, what if we do Bitcoin? What if you do like half a Bitcoin? And what if you do like a quarter of Bitcoin's like growth rate of hash over time?
I got you. Okay, so it kind of shows how.
And then normalizing it to like the prog power algorithm, and then saying like, what would that do in terms of like total scenarios? So you can see we start with 3 billion tokens, but depending on like what curve you take, you can end up at roughly year 20 with somewhere between, I think that's like 13 billion and 18 billion tokens on that path dependent curve. And the faster that it grows, the more tokens go out in supply. So like if it's able to like grow very quickly, the market's saying we want it to grow and we want more tokens. And so your net supply number actually ends up higher. And the slower that you grow, the lower the number ends up.
Yeah.
So the total supply is like a path dependent outcome, but
you're kind of within some kind of range.
There's a relatively tight range because of the logarithm in the system. Now there's also the path dependency of price, which is like a hard parameter to predict here. And so in this scenario, we just had the fixed like price number. This does not account for Qi. So like these numbers could actually be significantly different with Qi in the system. But the problem is, if you try to model this with Qi, the degrees of freedom are such that you basically are just painting a price curve. So like it's hard to model that. But if you were to try to model the supply with both Quai and Qi, the input to your model would include the price of Quai. So that's hard to do in like a reasonable way.
Okay.
I guess so. We didn't really publicly do that exercise.
Okay. But the key
for a number of reasons, obviously.
I think the key to take away here though is like this is not something that like one individual or people is just like deciding. This is built into the protocol itself, and this kind of correcting mechanism of the inflation rate is dependent on the hash rate and the inputs of the protocol.
Yeah. So this is like the real takeaway. This is like a great summary in some ways. Everything about the system is meant to have adaptive dynamic pieces that allows it to optimize to what the market determines is correct. Right. So if the market says you guys got too much pre-allocs, like it adjusts to like reduce the amount of pre-allocs that we had. If the market says the emissions is too high, like the emissions will come down. If the market says the emissions is too low, the emissions will go up. If the market says the price is too high, the price will come down. If the market says the price is too low, like the price will go up. If the supply of chi is too small, like the supply of chi will increase. If the supply of chi is too big, it will shrink. So like every parameter
within reason here, like, you know, there's a couple different curves that it could kind of be, but yeah.
Yeah. So like the elasticity of the curves and like the relationships are defined in the protocol mathematically.
Yeah.
But the path that the market chooses should ideally reflect the optimality of the outcomes. So, you know, if the market says like you guys got too much pre-allocs, it'll become more dilutive. If it says you guys didn't get enough allocs, it will become less dilutive. But like it's technically a market-derived outcome in all cases on like all parameters. Like that's the design of the system. Is the summary is you can never predict anything perfectly. You certainly can't predict things over periods of time. So what we did is we basically said, we will become prescriptive in the fewest things possible, and we will let the design of the other pieces ideally efficiently approach what the market determines to be correct. And if we do that, we can create the greatest, fastest accrual of capital possible. That was like the design statement. Like you want to like suck capital into the system. Like that's like the design of like these systems is you want to suck capital like as hard as possible. So to do that, like I need to be responsive to what capital wants. So if I allow the market to determine these parameters in a efficient market discoverable way, it should become as value accretive as possible.
I think this is a good point to end our episode. That was a fascinating conversation. We'll be back with part 4.
Appreciate it.